Corporate Finance Core, Topic 4, Stock Valuation. Learning Objective number 4, estimating the R, discount rate, and G, growth parameters in the valuation of stocks. So let's talk about growth. One of the most important numbers to estimate for valuing stocks would be the growth in dividends or the growth in cash flows, and particularly that perpetual growth. Or even just a growth in sales if you're doing a bottoms-up income statement. So one thing you might want to look at to try to get some idea of the growth in sales or earnings is look at the relationship between depreciation and capital expenditures. So here's the statement of cash flow. I got cash flows from operations and I got cash flows from investing, and I have CapEx and depreciation. Now this is Walmart. Look at their last 3 years of those numbers. In 2017, they had 10.1 billion of depreciation, 10.6 of CapEx. Next year, 10.5 billion of depreciation, 10 billion of CapEx, 10.7 of depreciation, 10.4 of CapEx. Sometimes we'll net these numbers out and say CapEx minus depreciation. So let's say for Walmart, they had 10.3 of CapEx minus 10.7 of depreciation. So it's minus 0.4 net CapEx. And again, net CapEx is just a number, a term we sometimes use for when we sum those numbers together or take the difference. So what that says, if you believe depreciation really is reflecting how assets wear out over time, in other words, you have to replace them. Walmart is basically, if you use that definition, just replacing its current assets. You know, if you have a new store, you depreciate over 30 years, you're just kind of refurbishing the store and you're not really increasing your capital stock at all. So this is an indication that they're not growing their number of stores. Maybe this CapEx is just kind of doing refurbishments year over year to get new lighting, new roofing, repave the parking lots, things like that, and sometimes remodel them. So, this is indicative of a company that's not really increasing its capital stock. So I would expect a company like that to have very low growth. Another thing to think about is another number that people use when estimating growth is sustainable growth. You remember that from topic 2. ROE times plowback divided by 1 minus ROE times plowback, and it's how much growth you can get without the need for external financing. So if I just use that measure, Walmart's ROE was 11.5% and was plowing back only 90% of its earnings. So the other 90% are being paid out as a dividend. So basically that 10% they're plowing back is earning 11.5%. And what that turns out to be is that company should only be able to grow 11 or 0.1%. So both these indicators are telling me that the growth for Walmart is low. They don't plow back a lot of their earnings to reinvest in CapEx, and they're not investing in CapEx. They're simply replacing the depreciating assets. And lastly, we'll talk about the interest rate. The two biggest factors in the DCF model is the terminal growth rate and the discount rate. Now the discount rate, I just gave it to you. For Walmart, I just said it was 6%, but we'll have a topic later that talks about that. But what I should say is that discount rate should be higher for riskier firms. So I'd expect the discount rate for Tesla to be greater than the discount rate for Walmart. So just because you would think it's just more volatile, as the market goes up and down, you think Tesla has bigger swings than Walmart. Now, a good estimate for discount rates is if you could say that the average return on the U.S. stock market, the S&P 500, the 500 biggest companies in the U.S., is about 7 to 10%. Based on whether you looked at the last 30, 50, 100 years. So, for kind of average stock or stocks that you think are kind of have average risk, I would say that 7 to 10% is kind of a reasonable value. And the riskier the company, maybe a little bit more than that. And the safest of companies in America, maybe a little bit less than that, maybe 5, 6. And the riskier, maybe a lot higher. Now, why would a company be riskier? Well, maybe their products just have are more luxury items, luxury cars. versus, say, economy cars. Or maybe their products are food and fuel, which are things which you don't reduce that much in recessions, versus things like spas. So, to the extent that your company sells luxury goods or things that you could reduce if times got bad, you would think those companies with those luxury goods would have a higher discount rate because they're riskier. And companies that sell food, especially during the pandemic, you can see, food stores and pharmacies are doing okay, along with other companies that sell those types of goods. And so you'd think they'd have a lower discount rate. Now, in future topics, we're going to actually give you a model to come up with that discount rate. And it's going to rely on two things. One called the weighted average cost of capital. That's basically the amount, the cost of raising funds at that company. And the other one is the capital asset pricing model, which is a way of thinking about risk and how to incorporate the risk into coming up with an expected return of a stock or a discount rate. So in this topic, we just talked about the important factors of the discount rate and growth parameters in valuing stocks.